Okay, thanks a lot, Mario. Hello, everyone. So as Mario said, I will give you a 20-minute presentation with just an overview of the main themes, main conclusions that came out of our forecast report this time. My presentation is entitled Riding the Global Growth Wave. The presentation will have 4 parts. The first one is the main one. I'll talk about the global backdrop for growth, why it's so good at the moment. I will go through the drivers of growth in the region and also our forecasts for 2018 to 20. Secondly, I will ask whether the region is overheating. Thirdly, beyond overheating or potential overheating, where are the risks to growth as we see them? And finally, I will discuss a little bit the outlook for long-term convergence in the region and ask whether Central and Eastern Europe can break out of a semi-periphery trap. So starting at the global level, what we see basically, global conditions are excellent. We have the big motors of the global economy, that means China, the US, and the Eurozone, growing strongly together for the first time since 2010. That's good news for the region. What is particularly good news is what's happening in the Eurozone, and especially in Germany. Germany is a very important trade partner for almost everyone in our region. But it's not only about trade, it's also as a source of investment, as a source of tourism, and also as a source of remittances. And conditions in Germany at the moment are effectively boom-like. The economy grew way more than 2% last year. We expect the same this year. It's very strong for Germany in the historical context. And also, as you see from the chart here below, business sentiment is at a multi-decade high. These developments we expect to continue, both at the global level and the Eurozone and the German level, and this is very positive and will remain very supportive of growth in Central and Eastern Europe during the forecast period. The implications of what we're seeing at the moment at the global and Eurozone level are very clear, I think, in the region. 2017 was the best year for growth in Central and Eastern Europe since 2011. It was also the first time that all 22 economies for which we provide forecasts grew since 2007. So we're at a very positive, very strong phase of the cycle at the moment in the region. See from the chart below, especially since 2016, a very clear improvement in growth in the EU members in the region, in Turkey, and actually even in the CIS and Ukraine. We've seen a slight tailing off in the last couple of years in the Western Balkans, but that has a lot to do with what's happening in Serbia. Bit of a slowdown in Serbia last year, but that already is changing. Serbian economy is coming back. It's key for the whole region, for the whole Western Balkan region. And so we don't expect this slowdown in the Western Balkans to last this year and beyond. What does that mean for revisions? Well, 2017, as you see below, was better than we expected, pretty much everywhere in the region. 2018, we also see basically upward revisions everywhere, at least on the sub-regional level. 2019 is a bit more mixed. In terms of our headline forecasts, they are pretty positive. We think this year and last year probably marked the peak, but still 2019, 2020, the numbers, the forecasts that we have are quite strong. Regional differentiation is there. I mean, that's been a theme across Central and Eastern Europe for a number of years now, where we've seen very good levels of activity in most of the EU member states and in Turkey. A mixed picture in the Western Balkans, also some countries there doing pretty well, and much weaker in the CIS in Ukraine and especially in Russia. As you see below, that's something that we expect to continue during the forecast period. But what I would say here is in terms of convergence at least, Germany, as I said, is growing strongly, but only a bit more than 2%, and it will gradually tail off as we get towards 2020, down towards 2%. Eurozone also will go down towards around 2% during the forecast period. That means that as you see from the forecast below, for most of the economies in the region, we're still going to see pretty good convergence with Western European income levels over the forecast period. Moving on now to the drivers of growth. We see several quite important drivers of growth. That's very positive, obviously. The most important one is consumption. It's the biggest part of the economy everywhere in the region. And here the outlook is very positive. You see from the chart on the left, we have very nice momentum now in labor markets in the region, especially in the EU members and in the Western Balkans, but actually this is a theme pretty much everywhere in the region. That is driving unemployment rates down. It is making labor markets tighter, and that in turn is pushing up real wages. It's also basically a theme everywhere in the region that real wages are recovering in pretty much all countries. That we expect to continue, and that will propel consumption growth through the next 2 or 3 years. An interesting sub-point here on the consumption story. So I said labor markets are tightening. We're actually seeing the emergence of labor shortages in some countries. Vacancy rates have spiked in some of the EU member states in particular. That is an issue for growth. There is a risk that these labor shortages become growth constraining. One thing that's helping to offset that, and we think will continue to at least in the next couple of years, is migration from within the region to the EU member states in the region where the labor markets are tighter. So that means from places like Serbia and Ukraine, which you see on the chart here, to countries like Poland and the Czech Republic. It's actually the case now that Ukrainian migrants represent a very important part of the labor market in some countries in the region. And this is not a long-term solution to labor shortages, but it's helping to offset them in the short term and preventing them from becoming too much of a constraint on growth at this point. The second key driver of growth that we see is investment. This is particularly important, particularly interesting, because investment has been such a laggard in the recovery across most of the region so far. It's been clearly the weakest performing part of GDP by expenditure in most countries. That changed quite clearly last year. We saw investment come back strongly in many countries in the region last year. That's something that we expect to continue, and we expect investment actually to grow faster than headline GDP growth in many parts of the region in the next couple of years. Quite a few different reasons for that. One, which you see on the chart here, is rising capacity utilization, which has shot up in the last few years in the countries for which we have comparable data, but there are other factors as well. Rising property prices, the next EU fund cycle, better confidence in the economic recovery. All of these we think are important. They're also durable, and they will keep driving investment during the forecast period. The third key driver of growth is the external sector. See from the chart below that all regions really have, or most regions at least, within Central and Eastern Europe have seen their export to GDP shares grow pretty strongly in the last decade, or even actually in the last 2 decades. That's mostly, it's the most obviously a theme in the Visegrad countries, but we see that, in many places. That means that the region is now, we think, much better able to take advantage of the upswing in the global economy, and especially in the Eurozone, than it was in previous years. We also don't think external competitiveness is in danger. We see, as I said, strong wage growth, actually very strong in some EU members, for example. But we also see very strong increases in productivity, increases in non-price competitiveness. We see very healthy trade balances as well. And so we don't think that external competitiveness is in danger at the moment, and nor will it become an issue in the next couple of years. I'd also stress here that we're not only talking about, when we talk about taking advantage of better external conditions, we're not only talking about goods exports. Services exports are also an important part of growth in many countries, for example, in the tourism sector. And we're actually seeing in parts of the Western Balkans, for example, something of a tourism boom at the moment, which is helping growth. And also on the external side, we're seeing very strong remittance inflows for those countries where remittances remain an important driver of growth. Given the situation in labour markets in countries like Germany and Switzerland, very important sources of remittances for the region, the tightness of labour markets in these countries, higher employment, higher wage growth in these countries is having a clear knock-on effect for remittances heading into parts of Central and Eastern Europe. We also think that the banking sector is in a good position to support growth at the moment. The banking sector has had a tough decade in much of the region, but on the asset quality side, we've seen very significant improvements in the last few years. You see below the non-performing loans ratio for the region has fallen pretty much everywhere. The exception is the CIS and Ukraine region. Puts banks in a much better position to extend credit. We also see important positive developments on the demand side. Consumers have a much higher willingness apparently now to take on credit. Interest rates are still very low. And as a result of this, we think that the banking sector will continue to support growth in the next, or even be in a better position to support growth in the next couple of years. One thing that we don't see is a return to the pre-crisis, highly leveraged funding model for banks in most of the region. There are a couple of exceptions, but what we've seen in general is a very sharp decline in the loans to deposit ratio during the last decade. What this means is that lending is now overwhelmingly deposit financed. That is something we expect to continue, and that will put a certain limit on how fast credit can grow in the forecast period. In the context of the conditions I've described, very strong growth in the region, strong wage increases, strong conditions in the labour market, it's relevant to ask, I think, whether Central and Eastern Europe is overheating. This was very prominent in the media towards the end of last year when we had the very strong third quarter growth numbers for Central and Eastern Europe. We created an index to try and assess the extent of overheating in the region. And our conclusion is, in general, for the region as a whole, we don't see overheating. That's particularly the case if you compare the current period to 2007, as you see on the chart below. I mean, that's an extreme example, but it's also a relevant comparison, I think. That's not to say that we don't see potential risks of overheating emerging. Our index is composed of 11 indicators. When you look at some of the sub-indicators for certain countries, you do see certain potential overheating pressures emerging. And there we would mention as examples the Czech Republic, Romania, and Turkey. So where are the risks to growth? There seems to be an opinion, quite widespread, that the risks to growth at the moment are quite low. If you look at the recent World Economic Forum Global Risk Report, for example, they had economic and financial risks way down the scale in terms of what respondents considered to be most concerning at the moment. That's not something that we agree with. We don't share that opinion. At the global level, we see three big risks for the region. One is the end of ultra-loose monetary policy, especially in the US, and whether that can be safely managed. The second is the potential bursting of bubbles in financial markets. One clear example of that was the volatility in the US stock market in February. And third is a potential trade war, which has become much more of a realistic threat in the last few days. We looked at this in a study last week in terms of what it would mean for Europe. Our view is that if it's only about metals and steel, if tariffs are only increased there, the implications are negative, but not drastically so. If it widens into a full-scale trade war, it will be much more of an issue for Europe, and actually maybe even especially for our region. On the regional level, we see five important risks for growth. One is pockets of high corporate and or sovereign leverage, and the way that in many countries this has increased quite sharply since the crisis. This is particularly an issue in the context of monetary tightening in the US. And if we get faster monetary tightening in the US than we currently expect, it seems unlikely, but it's not impossible. Certain countries in the region could certainly be in trouble. A second risk is East-West splits within the EU. This is more and more of an issue, probably. And one obvious economic implication from that would be what happens with the EU budget after 2020. It will probably be smaller after Brexit. That appears to mean that EU funds going east will be lower. Third is threats to the rule of law and the potential implications for private investor sentiment in the region. Fourth is the Ukraine crisis, which stays with us. It doesn't appear to be going away. It's clearly a risk for growth in Ukraine and to an extent Russia. Or not a risk, it means it's a problem that exists for growth in those countries. And fifth is a breakup of the Eurozone, which we definitely don't expect. It remains highly unlikely. But since the election in Italy, it's probably come back at least as a theme. So the final section of the presentation is looking a little bit further into the future and the prospects for long-term convergence in the region. As you see from the chart below, looking first at the grey and the yellow bars, convergence since 2000 has clearly been a success. We've seen convergence in every single country in the region. There is nevertheless a certain amount of disappointment with the convergence process in Central and Eastern Europe. And one part of that maybe is the lack of, or the slower wage convergence in some countries. And you see the examples below of Slovakia and the Czech Republic, where wage convergence is maybe roughly 10 percentage points of GDP less than per capita income convergence. As I said earlier, we're actually quite positive on convergence prospects for the next few years, and actually maybe in particular on wage convergence, given the tightness of labour markets and the momentum that we see there. There's scope for a certain amount of catch-up of wages with respect to headline GDP per capita in the next few years. Where we see greater challenges for convergence over the long term. We had two special topics in our report this time on long-term convergence prospects. One relates to demographic decline. You see here the demographic projections for the region are very negative, including in comparison with Western Europe. And we argued that could represent a constraint on growth by the 2020s, so not very far now into the future. The second long-term challenge we see is the implications of functional specialization patterns in the region. You see two countries below, Czech Republic and Austria, but these are representative in general of patterns that we see in Eastern Europe and in Western Europe. In Eastern Europe, what we see is very high level of specialization in production. What that means is specialization in part of the supply chain where a relatively small amount of value is created. That is in contrast to Western Europe, where specialization is in parts of the supply chain where very high levels of value are created. And our concern is that this creates the risk that Central Europe, having broken out of Central and Eastern Europe, having in many cases broken out of a middle income trap, will become stuck in what we call the semi-periphery trap. So that's it. Briefly to conclude, growth is at a very high level. We expect it to continue. We expect convergence to continue during the forecast period. In general, we don't see overheating, with a couple of exceptions. There are several risks to growth, including the potential for a broader trade war. And although we expect convergence to continue during the forecast period, we see some fairly significant longer-term challenges to the convergence process. So,
okay, thanks a lot, Richard. You mentioned 3 countries where maybe overheating might be an issue, at least in the future. That was the Czech Republic, Romania, and Turkey. Could you tell us a bit more about them?
Yeah. So, as I said, our basic conclusion is that we don't see overheating in the region at the moment. But as I said, there are 3 countries where potential risks of overheating are visible and where overheating could emerge. One is the Czech Republic, where we see very strong growth, very tight labor market, and very strong property price increases in particular. What we don't see in the Czech Republic, though, are serious imbalances emerging. This growth, it does not look very unbalanced to us. We don't see a big fiscal deficit, we don't see a big external deficit, and we also don't see big increases in private credit. This doesn't look like a very leveraged property market boom to us at the moment. Turkey and Romania are a little bit different. In Turkey, we see growth being driven to a large extent by a big external imbalance, which could create big risks further down the line. And in Romania, we see growth being driven to an extent by a very big fiscal deficit. You have an economy growing at almost 7%, with a fiscal deficit that's going to be over 3% of GDP this year. That doesn't look very balanced to us. That creates risks of a harder landing further down the line. So whereas we don't see it at the moment, I mean, these are the two countries where we think overheating is at least a risk.
We have here a more specific question on Turkey, whether you actually see the risk, whether the country is facing a balance of payments crisis anytime soon.
I mean, this is something that's been discussed a lot in the media at the moment, probably partly in reflection of the Moody's downgrade last week. I mean, the Moody's downgrade in itself, it's a downgrade within junk status. I mean, the key downgrades were when Turkey was moved from investment grade to junk status. So I think this downgrade on its own isn't going to move very much. Turkey's large current account deficit has existed for quite some time. That on its own will not cause a crisis. What has maybe changed is what I mentioned earlier is the direction of US monetary policy. As US rates rise, those countries with the big external financing needs, such as Turkey, face greater risks. If the Fed continues with a very slow and steady, very well telegraphed approach, which looks quite likely to us, these risks in Turkey won't necessarily materialize. Turkey has run bigger external deficits in the past. If US inflation spikes, which doesn't look very likely, but it's possible, and the Fed starts to tighten more aggressively, problems could emerge. The other thing that's changed is political factors, both domestic and maybe more importantly in this respect, externals, foreign politics, and the relationship with the US, which seems to be increasingly problematic. But as I said, I mean, I think what is most important, what really is the key is what happens with US inflation and US rates. And so we don't automatically see any kind of balance of payments crisis in Turkey.
Thanks. Walter Burkhardt is asking on the accession plans in the Western Balkans, which chapters are difficult to fulfill for the most likely candidate countries and the time horizons. Do you have an opinion? Or otherwise, I would say all chapters are pretty difficult to fulfill. Obviously, particularly the rule of law chapters and so on. In any case, at the moment, the most likely candidates, one might say, is Montenegro, Serbia. But this time horizon that was given recently by 2025 is very unlikely to be met by any of these countries. Because one issue is that actually all the territorial issues will be politically solved by that time, not to speak even about really fulfilling the chapters and the substance of the acquis communautaire. There is a question by Marek Dabrowski on the details of the construction of the overheating measure. Can you tell us?
I mean, I can. Unfortunately, I don't have time to give you all the details. I would encourage you to go to the report where there's a full explanation. Briefly, our idea was, so overheating indexes have been constructed in the past, for example, by the IMF, at times of potential overheating in the global economy. Our intention was to look more closely at Central and Eastern Europe, where there's been a gap. Previous indices have looked maybe at Turkey and Russia, but no other countries in our region. And because in particular we have this very strong growth and also wage growth and this tightness in the labor market in the region. We constructed the index based on three categories: the real economy, domestic finance, and external finance. And within each category, we have 3 to 5 indicators that we assess. We assess everything on a quarterly basis, on a 4-quarter moving average, and we compare it to a historical average. We look at the most recent data compared to the historical period in terms of standard deviations. And where we see 1 to 2 standard deviations away from the historical average in the direction of overheating, we see potential overheating risks. On aggregate level, no country in the region gets close to that many standard deviations from the historical average. That's why we say at the moment we don't see overheating. On certain measures, and so I mentioned them in respect to the Czech Republic, Turkey, and Romania, we see certain indicators in those countries hitting this test level for overheating. And that's where we would say the potential risks of overheating emerging. I would encourage you, the full data, the full explanation is in the report. I would encourage you to check more there.
Thanks. Lucas Lehner is asking about the trade war, basically, and the threat of rising protectionism. Which countries are affected most likely?
I mean, as I said, we produced a study last week where we looked at what the existing measures that have been announced could mean on steel and aluminium. And our conclusion is negative, but not too negative, not enough on its own to derail growth for our region. This is moving all the time. So, you know, we modeled this, then we found out that Canada and Mexico are exempted. We reran the model, then Australia was exempted, so it's moving all the time. We're looking now at what it would mean if we went to a bigger trade war and, for example, tariffs were raised on car imports to the US from Europe. That's something that Donald Trump threatened last year in relation to Germany. He threatened to increase tariffs on passenger cars to 35%, which would be a huge increase from current levels. That would certainly hit the region very hard, and actually maybe more the countries of Central and Eastern Europe than the countries of Western Europe. I mean, obviously Germany would be hit very hard by an escalation into a trade war involving cars, but if you look at shares in GDP, you can make the argument that actually some of the Visegrad countries, for example, would be even harder hit. And what we would see would be probably a direct hit to those countries, but also an indirect hit via Germany. That is something that certainly Europe, we think, would be or should be seeking to avoid if at all possible, because that would be very serious for growth in the region.
Okay, thanks. Evgenia Stepsova has a question on Romania and how whether it is able to join the euro by 2024, and particularly in the light of the recently widening imbalances. Do you have an opinion on that?
I mean, I think the answer is probably similar to the answer to is Romania overheating. I mean, I think what we see is imbalances that are clearly there, but we're quite far away from this becoming very serious. I mean, we're still at a stage where this can easily be clawed back. For example, what we expect this year is that the budget deficit limit will be breached and there will be a macro imbalance procedure against Romania, and that the cooling pressure will come from the outside, from the EU level. We did a study last year on potential euro accession for the 6 countries, I think 6 countries that are not currently EU members. Our view was that basically for every country except the Czech Republic, it makes sense. Czech Republic being the exception because it's not very Euroized. But even in the case of the Czech Republic, it wouldn't be a problem. And I think in terms of accession dates, 2024 for Romania is probably reasonable. I don't know if you have.
Yeah. Well, there is another question. We will return to that topic there. But in the meantime, Matthias Karabacik had a question on populism and issues of whether that will be a problem for FDI from Western Europe to Central and Eastern Europe. So I think we are talking basically about Poland, for instance, Hungary.
I think in case of Poland, we probably already see this a bit. Maybe not specifically in terms of FDI, but in terms of private investment in general. Investment came back stronger last year in the region, as I said, including in Poland. But in general, this is very heavily influenced by public investment. On the private side, what we are seeing, what we're hearing anecdotally, is that there's a lot of caution among private investors, and this is related specifically to challenges to the rule of law. I think there has been this perception for a long time that when countries join the EU, number one, their legal systems will gradually be aligned with a German kind of standard, and number two, that there is a mechanism to enforce this. I think both these things are now in doubt in at least certain countries in the region. Whether that's affecting FDI specifically now, maybe not the case, but it will probably become increasingly more the case over time. One thing you'll notice now forecasts is that we have Poland and especially Hungary tailing off towards 2020 more than, especially in the case of Hungary, more than the other countries in the region. The reason for that is that we're seeing a very aggressive drawdown of EU funds at the moment. More than other countries in the region. This may well be disguising a fair amount of weakness in private investment. And that is why we think by, say, 2019, 2020, growth overall will be much lower than it is now and also much lower than for the other EU members.
Okay. We have here another question about, again, the euro, Romania, but also here Croatia, and whether it could have positive effects or whether it is risky. But at least I think regarding Croatia, I think it would have mostly positive effects because the country is so strongly Euroized and de facto people are thinking, are trading in euro already. So it would just give additional features of stability in terms of the banking sector. It would be important for tourism in Croatia, so tourists could pay in euro and so on. So I think for Croatia, it is pretty clear that the euro would be a very positive element. Romania is probably a bit different still. The possibility to be able to have a devaluation in nominal terms might still mean something. It's also a bigger country with a industrial sector that is increasing.
Yeah, I mean, I would again direct you to the report from last year that I mentioned on specifically on. So we looked at the Czech Republic, Poland, Croatia, Bulgaria, Romania, and Hungary. And we found that in all cases except the Czech Republic, there's a clear positive case to join the euro. And even in the Czech Republic, it wouldn't be damaging. And so, I mean, I think that is basically the headline conclusion that we would have.
Then Walter Burkhardt has another question on political risks regarding Hungary. We have some elections in Hungary, and it looks like there will be early elections in Slovakia after also the Minister of Interior resigned. So how risky is this? Probably it can only improve, I would argue. For instance, in Slovakia, certainly it is in a political crisis at the moment. Early elections are a way out of this crisis and open the door for the proper investigation of the case, of this murder case. And in Hungary, it is not anymore clear that Fidesz will win again. So there have been these early elections in a certain town that surprisingly an independent candidate won. So that would be also increasing democratic political competition in the country, which I think this country really needs. So I think there is not a huge risk connected to the elections, upcoming elections. Then we have a question on...
Maybe one more thing on that. I mean, I think if you look at countries like Hungary, I think there's been this question for a long time. These political developments are quite significant, but do they matter for growth? I mean, in what ways can they directly affect growth? This is something that people have asked for quite a long time, and many people have said it doesn't matter. I think probably what we're seeing now is that it is starting to matter. And I'll go back again to the example of private investment in Poland, where we're seeing very tangible now implications for economic growth as a result of what is happening politically. And although the region at the moment is benefiting greatly from the upswing in Western Europe, I mean, the rising tide is really lifting all boats. When this upswing fades, I mean, I said 2017, 2018 is the peak. 2019 still looks pretty decent in the historical context, but growth will start to tail off, and even more in 2020. I think that's where you will start to see much more tangibly in the numbers the implications of these political developments in certain countries in the region, and the differentiation in terms of economic activity. And there was a question earlier about FDI. That might be one of the other areas where you start to see that investors are treating countries differently. I think Hungary, these trends are well established on the political side now. In Poland, it's been the last couple of years, and I think maybe there's a certain amount of wait and see. But as long as this continues in the political sphere, we do think that by 2020, this will be quite visible in the growth numbers. That actually leads on to the next question about if Brexit leads to an EU spending cut, which countries would be affected most. Our calculations are that the UK contributes, on average, over the last 5 years or so, 20% of the budget. That's obviously a significant amount. We think that, or we calculate that EU funds transfers, also net transfers from the EU budget, account for 2 to 5% of GDP in the Central and Eastern European EU members. And actually, I think I'm correct in saying that the highest is Hungary. So Hungary is more towards 5% of GDP. So you're talking in the Hungarian case, if we assume a simple across-the-board cut, 1% of GDP less from EU transfers after 2020. What may well be the case, though, is that the cut that falls on cohesion and structural funds may actually be bigger than that. And that will depend a lot on political developments. But I would not underestimate the extent of irritation with Eastern EU member states in certain parts of Western Europe, for example, in France. A lot of things are being brushed under the carpet in the EU because of Brexit, and that's understandable. But that will not remain the case indefinitely. And I think there may be a certain underestimation in parts of Central and Eastern Europe and some of the capitals about as I said, the level of irritation in parts of Western Europe with what's going on, and also then the potential implications for the region of that, of which changes in the EU budget would be a very important one. If I remember correctly, particularly the Baltic countries were always able to draw a lot of a high share of those earmarked EU funds. But in essence, I think it's important for all these countries because particularly in low growth periods, as we observed in recent years, because these EU funds are directly targeting gross fixed capital formation, both in the public as well as in the private sector. So another issue which comes to my mind related to Brexit is the question whether we can expect any return migration, for instance, of Poles returning to
Poland after the Brexit?
I mean, we've seen big changes in net migration numbers to the UK from other EU countries. That's clear that Brexit's already having an effect. The question is, where are those people just going home? We don't really think that's the case, especially in the case of Eastern Europe. What we think is more likely is that people who are minded from Eastern European EU members, people who are minded to go to Western Europe to work, will go to other places. For example, here in Austria, Germany, the Netherlands, countries like that. That means that the tightness that we're seeing in labour markets in some parts of the region will persist, and that's why these intra-Eastern European migration flows from places like Serbia and Ukraine into the Eastern European members is very important. Probably the main reason why we don't expect people to go back to the region from the UK in very large numbers in the next few years is because the wage gap is still so big. I showed this chart towards the end of the presentation on wage convergence in purchasing power parity terms. And what you see in the region is basically from 20% of the Austrian level in Ukraine to 70% in Slovenia, and the rest somewhere in between, in kind of the high 40s, 50% of the Austrian level. So it's still a very big gap. It may narrow in the next few years, but probably not decisively. And as a result, yeah, we don't see a huge amount of reverse migration from the UK back to Central and Eastern Europe has been very likely.
Let me come maybe back to the actual forecast figures, and which really strikes me is that still, although in the positive territory, CIS, Ukraine region, has really the lowest growth forecasts from all of these 22 economies we are covering. And if I see this correctly, Russian growth is particularly low. How comes?
It's an interesting question, because I think there's an assumption that, to a large extent, growth in this region is about the oil price. And so if the oil price is rising, I mean, it's much higher now than it was a couple of years ago or even last year, that should benefit all economies in the region. I mean, the rise in the oil price is helping Russia and the other economies in the region. But what we see more generally in Russia is a severe lack, as our colleague who covers Russia terms it in our report, a severe lack of economic dynamism. The Russian economy has been growing slowly for a while. It lacks a modernization strategy. It lacks a diversification strategy. It has been hit hard by sanctions. The comparison with Ukraine is probably more simply about the scale of the contraction in Ukraine. Ukraine has had a very, very bad couple of years, and as a result, it's not surprising that the bounce back is a bit stronger than in the case of Russia. Kazakhstan and Belarus look better. That will remain the case during the forecast period, but we think Russia will struggle even to achieve 2% growth, and that if anything will then trend downwards even further over the forecast period. Without very significant changes to the way the economy is structured, without a much stronger modernization, diversification strategy, and probably also without a significant rapprochement with Ukraine and the EU, the long-term outlook for the Russian economy is very poor.
Okay. But let us not end this story with these negative news, because overall it could be said the region is booming, at least according to the standards after the outbreak of the global financial crisis. So we have highest growth since
2011.
Highest growth since 2011, and since 2007, all countries of the region are finally growing. So I think with this positive news, we can end this webinar, and we would like to say thank you to all the colleagues who joined us and asked questions.
Thank you.